Right now, as you're watching this, missiles are flying in the Middle East. Israeli jets have struck Iranian nuclear and military sites. Iran has fired back, and somewhere in a trading room in London, in Singapore, in New York, a very calm, very wealthy trader is already sitting at their screen, smiling, because they knew exactly what was coming. And if you're watching this before Monday's market opened, you still have a window, a narrow one, to position yourself the right way before the rest of the world catches up. Welcome back to Silver Signals. I'm Yali Jiang, and if you're new here, this channel is where we cut through the noise and talk about what actually matters in precious metals and real-world investing. Today, we are doing something urgent and specific. We're going to talk about the Iran-Israel conflict, what it means for gold and silver prices right now, and why a gap-up opening on Monday is not just possible, it's historically almost certain. Most importantly, I'm going to walk you through exactly how to think about trading bullion when this kind of geopolitical shock hits. This is the kind of video that could genuinely save you from making an expensive mistake, or help you see an opportunity that most people will completely miss. So if you haven't subscribed to Silver Signals yet, please hit that button right now, because this is the kind of analysis we bring you week after week, and you do not want to miss what's coming. On June 13th, 2025, Israel launched a massive strike using over 200 aircraft targeting Iranian nuclear and energy infrastructure. Iran retaliated, and the Strait of Hormuz, that narrow critical choke point through which roughly 21 million barrels of oil pass every single day, suddenly became the most important piece of water on the planet. Oil surged more than 10% in days. The Dow dropped nearly 2%. The S&P 500 shed over 1%. And gold did what gold always does when the world catches fire. It rallied. Safe haven flows poured in and silver followed, because silver always follows gold in fear, and then often surpasses it in the recovery. Now here's what you need to understand before we go any further. A lot of people look at a situation like this, and they think in one dimension, they think conflict equals gold goes up, buy everything, and that is exactly the kind of thinking that gets people burned. The reality of trading precious metals during geopolitical shocks is far more nuanced and far more profitable if you actually understand the mechanics. So let's go deep on this. The first thing you need to grasp is the gap-up phenomenon itself. When markets close on a Friday and over the weekend the geopolitical situation meaningfully deteriorates, you almost always see what traders call a gap up in gold when Asian markets open Sunday evening. Think of it like a pressure valve. All that anxiety, all that new information that couldn't be priced in while markets were closed, it all gets released in one burst at the open. And because gold is traded nearly 24 hours a day through futures markets in Shanghai, Hong Kong, Dubai, and then London, that gap-up move often happens before most Western retail investors even have their morning coffee. By the time the alarm goes off in Chicago or Toronto, the move has already happened, and if you're not positioned before the Sunday night open, you are already late. Now, does that mean you should panic buy Monday morning at the open? Absolutely not, and this is where most retail investors make their most costly error. They see the gap-up, they feel the fear, the urgency, and they chase. They buy gold ETFs, silver futures, bullion at the peak of the fear spike, and then what happens? The market stabilizes, headlines start mentioning ceasefire talks or diplomatic channels, oil pulls back slightly, and suddenly the gold position they bought at the top is underwater within 48 hours. This has happened over and over and over again. UBS analyzed 11 major geopolitical events going back to the Gulf War, and you know what they found? 1 week after the event, the S&P 500 was on average only 0.3% lower, and 12 months later, up an average of 7.7%. The initial panic move in gold is often more emotion than fundamental repricing, and understanding this one fact alone can protect you from losing serious money in the first few hours of Monday's session. So here's how to actually think about this intelligently, and I want to pause right here and genuinely ask, what is your instinct when you see a headline like this? Do you feel the urge to buy immediately? Do you feel paralyzed? Or do you have a plan? Drop your answer in the comments below, because I read every single one, and this is something I want to understand about where our community is. Your mindset in moments of market panic is one of the most important things to develop as an investor, and hearing from you helps me create better content for exactly these situations. Back to the strategy. The smart money, and I mean the institutional money, the hedge funds, the sovereign wealth funds, they are not buying the spike. In many cases, they were already positioned before the headlines hit. What they are doing now is managing their existing positions and looking for secondary moves. So what should you be doing, and how do you separate intelligent action from emotional reaction? The first principle is this: separate the geopolitical trade from the macro trade, because the geopolitical trade, the fear spike, is short duration, typically lasting anywhere from 1 to 7 trading days before either escalating into something bigger or fading as markets absorb the news. Bank of America made a brilliant point about this. Conflicts are not usually a sustained bullish price driver, and what drives gold on a sustained basis is something else entirely. U.S. deficits, dollar weakness, real interest rates, and central bank buying. And here's the thing. All of those macro tailwinds were already in place before a single missile was fired, and Buffett's 12-month gold price target of $4,000 per ounce is based on fiscal deficits, not on geopolitics. The Iran-Israel conflict is just the match that lit an already very dry forest. So when you're sitting at your screen Monday morning and you see gold gapping up, maybe $50, maybe $80 at the open, here is a practical framework. First, do not chase the open. Seriously, write it on a sticky note and put it on your monitor. Let the initial volatility settle, because in the first hour of trading you will see wild emotional swings driven by panic buyers and short sellers clashing, and that is not where you want to be. The second thing you do is identify your key technical levels. Where was gold trading before the conflict escalated? Because that zone becomes your reference point. If the gap up takes gold $20 to $30 above a major resistance level, you want to watch very carefully whether it holds above that level or gets rejected back below. A hold and consolidation above the level on volume is a green light, but a spike and rejection is a warning sign that the move is emotional and not structural. Third, and this is specifically for silver, watch the gold to silver ratio, because right now that ratio has been elevated, which means silver has been lagging gold. In a sustained fear environment, silver tends to catch up violently, and if gold holds its gains into Tuesday and Wednesday, silver could see an outsized percentage move. That asymmetry is where some very interesting opportunity lives, and it's the kind of thing most people, watching the gold headlines, completely overlook. Now, let me talk about physical bullion specifically, because this channel is called Silver Signals, and a lot of you hold physical metal, bars, coins, or you're thinking about adding to your stack. During conflict-driven spikes, the premium on physical metal often widens before the spot price even fully adjusts. Dealers get hit with demand surges, supply chains tighten, and if you're thinking of buying physical on a Monday following a weekend conflict escalation, you may find yourself paying a significantly higher premium than you would have paid the Friday before. The metal hasn't changed, the value hasn't changed, but the fear premium has, and that is something important to factor into your decision. For long-term holders, and look, if you're a stacker, you know who you are, short-term premium spikes are less of an issue because you're buying for the decade, not the day. But if you're trying to time a physical purchase, the week after a major geopolitical event is usually not the best entry, and waiting for the dust to settle will often get you better pricing on both spot and premiums. Patience here is not weakness. Patience here is discipline, and discipline is what separates the investors who build real wealth from the ones who constantly chase. Here's something interesting that most people don't talk about. While global investors are watching gold from the outside, watching prices and ETF flows, something is happening inside Iran that tells a much deeper story. The Iranian rial has been in freefall, and ordinary Iranian citizens have been converting everything they could into physical gold, coins, bars, jewelry, anything tangible. Because when your national currency is collapsing, when sanctions are squeezing your economy, when bombs are falling, gold is the one thing that holds value, crosses borders, and doesn't need a functioning banking system or government promises. And this is not unique to Iran. This is human behavior across cultures and centuries. The same instinct that drove people in Venezuela, in Zimbabwe, in Weimar Germany to seek the safety of metal when paper failed them. Gold doesn't just react to conflict. Gold is the antidote to the very uncertainty that conflict creates. And watching what ordinary people do with their savings in war zones tells you more about gold's true purpose than any analyst report ever could. This is the deepest reason to own precious metals, not to trade them, but to understand what they represent in a world where nothing else is guaranteed. And now here's the twist. The thing I want you to really sit with, because this is the insight that separates a good investor from a great one. The Iran-Israel conflict is not the real story for gold. I know that sounds strange when I've just spent this entire video talking about it, but the conflict is the headline while the fundamental story is the United States debt trajectory. The one big beautiful bill moving through Congress is projected by the Congressional Budget Office to add $3 trillion to U.S. deficits over the coming decade. And investors are already pricing in higher long-term interest rates, a weaker dollar, and a potential loss of confidence in U.S. Treasuries as the world's premier reserve asset. Central banks globally, China, India, Poland, Turkey, have been buying gold at record pace because they are quietly preparing for a world where the dollar's dominance is no longer guaranteed. The Iran-Israel conflict is the spark, but the powder keg was already sitting there, and that is why this moment is different from previous geopolitical spikes that faded quickly. You are watching the intersection of a regional war and a structural monetary transformation happening simultaneously, and that is an extraordinarily rare environment for precious metals. Let me bring this back to where we started. That trader sitting in a dealing room, smiling at their screen, wasn't smiling because they predicted the missiles, because nobody can predict the exact timing of war. They were smiling because they had built a position over months, grounded in the understanding of deficits, dollar dynamics, and the historical role of gold as the ultimate safe haven. And when the geopolitical shock arrived, it simply accelerated a move they were already on the right side of. That is the mentality we want to build here at Silver Signals. Not reactive, not panicked, not chasing, but informed, positioned, and patient. So here's your action plan going into Monday. Watch the Sunday evening futures open as your first signal. And if gold gaps up significantly, note the levels, but don't chase. Let the first hour of Monday trade settle. Watch the gold to silver ratio for catch-up dynamics in silver. And if you're a physical buyer, be aware of premium expansion. And consider waiting unless you're a long-term accumulator. And above all, keep your eye on the macro backdrop and not just the headlines, because the headlines will change daily, but the macro story will not. If this kind of deep dive analysis is what you come to Silver Signals for, then please take 2 seconds and hit the like button, because it genuinely helps this channel reach more people who need this kind of information in moments exactly like this. And if you haven't subscribed yet, now is the perfect time, because we cover precious metals, market strategy, and wealth preservation from a global perspective, and we do not water it down. I'm Yali Jiang. Thank you for being part of this community. Stay informed, stay strategic, and I'll see you in the next one.